Hello, I'm Eric Pettway, Chief Investment Officer at Journey Advisory Group. As we close out an outstanding year with this final CIO Corner of 2025, I want to extend a heartfelt thank you for letting us deliver insightful information from JAG every 2 weeks. Thanks to your support, CIO Corner has seen tremendous growth, now attracting nearly 20,000 viewers every 2 weeks. If you're enjoying our content and want to be part of this increased momentum, please share CIO Corner with your friends and colleagues and show your support by liking us on your favorite social media platform. In this CIO Corner, we'll briefly cover 2025 and focus mainly on 3 key strategic themes for 2026. As we look back on 2025, the stock market is set to deliver strong returns for the 6th time in 7 years, with only 2022 seeing a downturn due to inflation. Recent gains extend beyond AI stocks, including global markets and fixed income, though high valuations prompt investor caution similar to past peaks. In 2025, inflation stabilized around 3%, tariffs were less disruptive than expected, and Federal Reserve rate cuts supported growth. Many fear risks, such as recession, did not happen. Actual market shocks are far less common than predicted ones. As 2026 approaches, key issues include elections, Fed leadership changes, AI advancements, loan portfolio concerns, and currency trends. Successful investing relies on managing uncertainty and focusing on long-term growth, not predicting every event. 3 strategic themes will guide investors in 26. The first is economic growth is slowing but remains positive. Economic growth has slowed but remains resilient. U.S. GDP dipped slightly in early 2025 before rebounding, posting a strong 3.8% second quarter growth rate. The IMF forecasts global GDP growth will decrease marginally from 3.2% in 2024 to 3.1% in 2026, with advanced economies at above 1.5% and emerging markets above 4%. Despite overall gains, economic progress varies by income group and sector, a 2-speed or K-shaped economy, largely due to tech trends like AI benefiting some more than others. Additionally, factors such as consumer debt and loan delinquencies shape whether individuals see the advantages of this growth. Long-term economic growth relies on rising productivity, which reflects the output a worker produces over time. Advances in technology, equipment, training, and education have historically boosted productivity, fueling real economic growth. As the chart shows, productivity growth averaged only 1.2% per year during the 2010s. The hope of AI and new technologies is a boost to worker output. However, this often takes longer than expected and won't necessarily benefit everyone equally. For investors, the promise of greater productivity is that profit margins can improve, supporting the broader economy and investor portfolios. The second theme, midterm election and government debt, will be at the forefront in 2026. In 2025, a 43-day government shutdown and concerns about the budget deficit highlighted ongoing fiscal challenges. The One Big Beautiful Bill introduced tax changes that provided more clarity for investors and taxpayers, including potentially larger refunds from full expensing of research and development. As the short-term funding bill expires in January, uncertainty continues, with another potential shutdown looming. Investors are also watching the upcoming midterm election, which could impact tariffs, regulation, and spending. Historically, midterms have brought an average market return of 8.6% since 1933. However, the rising national debt, now over $36 trillion, or about $106,000 per person, remains a significant concern, with the Big Beautiful Bill projected next to add to over $4 trillion in the next decade. While debt levels may affect economic growth and interest rates, history should suggest that they should not dictate investment strategies. Instead, investors should focus on understanding the new tax legislation, such as permanent tax cuts, higher state tax exemptions, and increased SALT deduction caps, to optimize long-term planning and tax strategies. The third theme, the Federal Reserve will support the economy. The Fed resumed rate cuts in September, following an earlier pause. Entering 2026, monetary policy may become less predictable as concerns shift from inflation to weaker job market, likely prompting smaller policy adjustments instead of major changes. Powell's term as Fed chair ends in May 2026, and his successor is expected to support further rate cuts to align with the White House's focus on lower rate interest rates. The chart illustrates that the economy has done well under Fed chairs from both parties. The Fed mainly influences short-term rates, while long-term rates are affected by factors like growth, inflation, and productivity. Investors should focus on these broader trends, not just Fed actions, to gauge interest rate and bond impacts. In 2026, investors should recognize that patience often pays off despite ongoing concerns. Not all expected crises happen, so maintaining focus and balance is crucial for long-term investment success. We hope the CIO Corner and the Chart of the Week are helpful in these uncertain times. If you enjoy JAG's content, follow us on LinkedIn or your preferred social media channel. If you have concerns or want to review your portfolio, catch your JAG team to discuss your goals and stay on track. And remember, remain calm, stay focused, and most importantly, stay the course.